Welcome to Talk Tickers. This is the show where we cut through the noise, strip away all the sensationalism, and get right to the signal on the financial narratives that actually impact your portfolio.
Great to be here. And today, we're not just looking at a narrative, we're really digging into the plumbing of the stock market. This is a mechanics deep dive.
It really is.
Yeah.
We are unpacking a huge structural shift that's been described as, well, everything from the democratization of trading to a ticking time bomb.
Right.
A time bomb just waiting to blow up the S&P 500. We're talking about the explosive, almost vertical rise of zero-day to expiry options.
Or zero DTEs, as you'll see them everywhere.
Exactly, zero DTEs.
And just to be super clear from the start, because the jargon can get thick really fast, these are options contracts with a lifespan of less than 24 hours. You buy them in the morning, and by 4:00 p.m. Eastern, they're done.
Right. So the closing bell rings and they either pay out, a huge amount or they expire completely worthless.
It's very high speed, high stakes finance.
And high volume. That's really the hook here, isn't it? If this were just a few traders on Reddit mess around, we wouldn't be talking about it. But the numbers are frankly startling.
They're impossible to ignore. We've seen zero DTEs go from being this tiny sliver of the market, basically a rounding error a few years ago, to now accounting for somewhere between 40 and 50% of the total options volume on the S&P 500.
Just think about that. Nearly half the volume.
Yeah.
It's a massive, massive migration of liquidity. So the mission for this deep dive is clear. We need to figure out, is this just a new tool for generating yield?
Yeah.
Or are we scaring down the barrel of Volmageddon 2.0?
That's the big scary word in the room.
It is. Are we building a systemic risk that could just wipe out all intraday liquidity and crash the market before you can even react?
And that is the central debate. Is this phantom liquidity that just vanishes when you need it most? Or is this new volume actually, dampening volatility and keeping markets safer on a day-to-day basis?
Okay, so let's start with the how. How did this happen so fast? It feels like just yesterday options were these sleepy things you bought once a month.
It was a gradual evolution towards speed. I mean, you go back a decade and you had OpEx week once a month.
Right, it was a ritual.
It was. You had to plan your trades weeks in advance. Then the exchanges introduced weeklies.
Which expired every Friday.
Exactly. And that started to shorten the market's attention span. But the real catalyst, the thing that changed the physics of the market, happened in 2022. The exchanges, they filled in the calendar.
They added Tuesday and Thursday expirations.
That was the final piece. Suddenly, you could trade a contract that expired every single day of the week, Monday, Tuesday, Wednesday, Thursday, Friday.
And the volume just exploded.
It followed the opportunity almost instantly. You look at a chart of the volume from 2022, 2023, it's just a hockey stick. It goes vertical. The CBOE now gets over half its revenue from its options business, largely driven by this.
That's an interesting point because the incentives are all aligned to keep this going. But you mentioned Volmageddon. Let's pause there. For people who weren't trading in February 2018, that might just sound like a buzzword. What was Volmageddon 1.0?
Sure. Volmageddon 1.0 was basically a crash caused by a feedback loop. There was this very, very crowded trade where everyone was betting volatility would stay low.
The short vol trade, using a product called Volmageddon.
Right. And it was like free money for a while. The market was calm. Everyone was collecting premium.
Until it wasn't.
Volatility spiked just a little bit. And the mechanics of that product forced it to buy volatility to hedge itself. That buying pushed volatility up more, which forced it to buy even more.
A death spiral.
It wiped out billions of dollars in minutes. The product just imploded overnight.
So the fear now is that zero DTEs are just the sequel, Volmageddon 2.0.
That is the bear case, 100%. You have analysts at major banks ringing the alarm bell on this. They warn that all this zero DTE volume is creating phantom liquidity.
And the nightmare scenario is a 20% intraday wipeout.
A 20% crash in a day. That's 1987 territory. But then on the other side of the coin, you have data showing the exact opposite might be happening. The market seems pinned. Incredibly calm.
Which is the paradox, right?
Yeah.
How can an instrument that's pure speculation, pure volatility, actually make the market more stable?
To understand that, we have to talk about the mechanics. We have to talk about gamma.
Okay, let's do it. But keep it simple. Gamma sounds like something out of a physics textbook.
It's just the acceleration pedal. It measures how fast an options price changes when the stock price moves.
Give me an analogy.
Okay. Imagine you have a bet on a basketball game. If the game is in the first quarter, one basket doesn't change your odds of winning very much. That's low gamma.
Okay, stable.
Now imagine there are 10 seconds left in the game. Score is tied. Every single dribble, every shot swings your probability of winning from 0% to 100% and back again.
That's high gamma.
That is extremely high gamma. And zero DTEs are always the last 10 seconds of the game. Their gamma is explosive.
So the options price is swinging wildly. I get that. But why does that crash the market? If my lottery ticket changes value, it doesn't, burn down the store.
It does if the store has to hedge your bet. See, for every option you buy, someone on the other side is selling it to you. Usually that's a market maker, a dealer.
The house.
The house. And the house does not gamble. Rule number 1. Market makers want to be delta neutral. They don't care if the market goes up or down. They just want to collect the spread.
So they have to hedge. They can't just cross their fingers and hope you lose.
They have to hedge aggressively. And this is where the reflexivity loop, the so-called doom loop, comes from.
Okay, walk us through it. The nightmare scenario. How does this break everything?
All right. Let's say the market is nervous. People are scared. So they rush in and buy puts. They're betting on a crash. The dealers sell them those puts.
Okay.
This leaves the dealers short gamma.
Meaning they're on the hook if things get wild.
Exactly. So now watch what happens. The market drops 1%. The dealer's risk models start flashing red. Because they're short all these puts, the math dictates that to hedge their position, they must sell the underlying stock.
Wait, so the market drops and the dealers sell more stock into that drop?
Yes, they sell stock. And that selling pressure pushes the market down, say, another 0.5%. And now their models scream, the market is even lower, your risk is higher, sell more.
It's a self-fulfilling prophecy.
It's a liquidity cascade. The mechanical selling from the dealers drives the price down, which forces them to do more mechanical selling. Some estimates say in a severe shock, dealers might have to dump over $10 billion of stock instantly.
Which just evaporates the order book. There are no buyers left.
And that's the one-sided fear, that everyone piles into one side of the boat buying, puts in a panic, and forces the dealers to sink the ship just to keep themselves afloat.
That's the theory. And the math behind it is scary.
It is scary math if everyone is indeed on one side of the boat.
But, and this is the big twist, right? The actual data on who's trading tells a very different story. The media narrative is that this is all D's gambling on trading apps.
That is the myth. The headline view is, retail traders buying lottery tickets on their lunch break. And look, retail is definitely present. They are a big part of the volume.
But they're not the whole story.
Not even close.
Yeah.
When you look at the big institutional flows, the picture changes completely. The whales here are wealth managers, RIAs, systematic funds. And here's the key. They aren't buying lottery tickets.
They're doing the opposite.
They're selling them. They're acting like the casino.
Okay, so why? Why are they doing that?
Well, think about 2022. Stocks were falling, bonds were falling, the 60-40 portfolio was getting crushed. Managers needed to find yield somewhere, anywhere.
And they needed to squeeze juice from a dry lemon.
Exactly. So they started systematically selling zero DTE calls and puts to harvest that rich premium. They're selling volatility to generate income, a yield overlay strategy.
Okay, so if the big institutions are selling options, that means the dealers on the other side of that trade are buying them.
Correct. And this is the critical point that explains why the market hasn't blown up yet. If a dealer is buying options from these institutions, they are long gamma.
So, flip the reflexivity loop for me. If a dealer is long gamma, what does their hedging look like?
It completely inverts. Instead of making the market more unstable, a long gamma position forces the dealer to stabilize it.
How?
Okay, so the dealer's long gamma, the market drops. To hedge that position, their models tell them to buy stock to rebalance. If the market rallies, they need to sell stock.
So they're trading against the trend. They're buying the dips and selling the rips.
Precisely. They become a shock absorber. It's called intraday mean reversion. You have all these institutions systematically selling options, the dealers are in the middle, and their hedging activity literally compresses volatility. It pins the S&P 500 in this tight little range.
That explains so much about the market action we've been seeing. You see the market start to sell off in the morning, and then it just stops and floats back to the middle. It feels like it's stuck in mud.
That's the zero DTE pin. And the data shows it. Most of the volume is in the first hour of trading, and it's all focused on strikes that are just slightly out of the money. It's yield harvesting, not doomsday betting.
So, does this mean the Volmageddon risk is zero? Is the whole thing just a ghost story?
I wouldn't go that far. It's not that the danger is made up. It's that the mechanism is, I think, Misunderstood. I like to think of zero DTEs not as a bomb, but as an accelerant.
An accelerant. Explain that.
Well, zero DTEs don't start fires. Like we just said, on a normal day, the mean reversion flows stabilize everything. The dealers are a wet blanket on any big moves.
But what happens if a match gets lit somewhere else?
Exactly. Imagine a real tail event. A massive geopolitical shock. A surprise inflation print that nobody saw coming. The market doesn't just drip 0.5%, it gaps down 3% instantly.
Okay, so it blows past that comfortable little range where the yield harvesters are playing.
Right. And all of a sudden, those institutions who are selling puts for income, they're getting destroyed. They're way underwater. They rush to close their positions.
And to close a short put, you have to buy it back.
Which spikes the price. And at the same time, the dealers flip. The market has moved so far, so fast, that their long gamma protection evaporates or inverts. They go from being stabilizers to being forced, mechanical sellers.
So the stabilizer only works within a certain band. And if you break that band, the dampener becomes an amplifier.
Precisely. It's like a heavy lid on a pressure cooker. It keeps everything calm during normal heating. But if you crank the heat to maximum, if a real crisis hits, that tight lid means the eventual explosion is going to be far more violent.
Wow. So we're effectively trading small daily volatility for the risk of a massive catastrophic event down the line.
We're suppressing the small tremors, which might just be setting us up for the big one.
There's another side effect I want to touch on because this affects every buy and hold investor listening. It's about the cost of real insurance, the variance risk premium.
Right, the VRP. It sounds academic, but it really hits your bottom line. The VRP is basically the profit margin for selling insurance on the market. Historically, what you pay for an option is higher than what the market actually does.
That spread is the profit.
It is. But what the research shows is that because there's so much supply, so many institutions selling these daily contracts, it's crushing the VRP.
It's making short-term insurance artificially cheap.
Very cheap. But here's the trap. Investors see that cheap price, and they start to assume the risk has actually gone away. We're seeing this cannibalization.
Right. People are swapping their long-term hedges for these cheap daily bets.
Exactly. The data shows volumes for longer-dated options are dropping relative to zero DTEs. People think, why buy a 30-day hedge when I can just grab a cheap zero DPE if things look scary today?
And we saw why that's a massive trap during the banking crisis in March 2023.
That was the perfect litmus test. Remember Silicon Valley Bank?
Hard to forget.
When SVB went under, did investors rush to zero DTEs to protect themselves? No. They flocked back to the VIX and 30-day options. Because zero DTEs expire at 4:00 p.m. If a bank fails overnight, or over a weekend, or a war starts at 3 a.m., your zero DTE put is worthless. It's gone. It did nothing for you.
That's such a critical point. The VIX is for insurance. Zero DTE is for speculation or income, and confusing the two is incredibly dangerous.
It's like canceling your fire insurance and deciding to just buy a lottery ticket every day instead, hoping that if your house burns down, you'll win the lottery that same day to pay for it. It's not a hedge.
That brings us perfectly to our segment, The One Question. If you're listening, you're probably looking at your portfolio, wondering if you should be touching these things. So what is the single most important question a listener should ask themselves about zero DTEs?
The question is, are you mistaking a speculative tool for a hedging instrument?
Drill down on that. Why that question?
Because the leverage is seductive. Zero DTEs can offer, 20-to-1 returns in a few hours. When you see that, your brain can trick you into thinking, I can use this to protect my retirement account. But you can't.
Because of that time decay, that expiration.
Because they are structurally incapable of protecting you against a real, prolonged crisis. Using them to hedge a long-term portfolio is like buying car insurance that expires every day at sunset. It leaves you totally naked against the biggest risks, which almost always happen overnight or over weekends.
So let's recap the main takeaways. We have a market that has fundamentally changed. Half the volume is now daily. That's the new reality.
Correct. And that volume is a double-edged sword. In calm markets, it provides liquidity and pins the market. It actually reduces volatility day to day.
But in a crisis?
In a crisis, that liquidity is a mirage. If an external shock pushes the market too far too fast, the stabilizing flows vanish, the dealers flip, and that dampener becomes an accelerant.
It really just goes to show that while the tools of the market change, from paper tickets to algorithms to zero DPEs, the underlying dynamics of fear and greed, they never change.
History doesn't repeat, but it certainly rhymes. And we haven't seen the full zero DTE crash test yet. We haven't had that true black swan day since this volume took over the market.
So one final thought for you to chew on. If zero DTEs are constantly compressing volatility, pinning the market to these arbitrary strike prices every day, what is that doing to actual price discovery?
That is the multi-trillion-dollar question.
If prices can't really move because of these option flows, are stock prices even reflecting the fundamentals of the companies anymore? Or are we just trading derivatives of derivatives?
Yeah, when the tail starts wagging the dog, where's the dog actually trying to go? We might not find out until this whole structure gets truly tested.
Something to think about next time you see the market flatline at 2:00 p.m. Thanks for listening to Talk Tickers. We'll catch you on the next deep dive.